Learning objective number 7 is to compute the margin of safety and explain its significance. The margin of safety helps management assess how far above or below the break-even point the company is currently operating. To calculate the margin of safety in dollars, we take total current sales and subtract break-even sales. Let's calculate the margin of safety for RBC. RBC is currently selling 500 bikes and producing total sales revenue of $250,000. Sales at the break-even point are $200,000, so the company's margin of safety is $50,000. We can express the margin of safety as a percent of sales. The margin of safety percentage is equal to the margin of safety in dollars, $50,000, divided by the total budgeted or actual sales in dollars. In the case of RBC, the margin of safety is 20%, $50,000 divided by $250,000. The margin of safety can be expressed in terms of the number of units sold. The margin of safety at racing is $50,000, and each bike sells for $500, so the margin of safety in units is 100 bikes. Racing bicycle is selling 100 more bikes than are needed to break even. Let's see if you can calculate the margin of safety in cups of coffee for the coffee clutch. The margin of safety is 950 cups. Learning objective number 8 is to compute the degree of operating leverage at a particular level of sales and explain how it can be used to predict changes in net operating income. Operating leverage is a measure of how sensitive net operating income is to percentage changes in sales. The degree of operating leverage is a measure, at any given level of sales, of how a percentage change in sales volume will affect profits. It is computed by dividing contribution margin by net operating income. Let's look at racing bicycle. Recall that racing is currently selling 500 bikes and producing net income of $20,000. Contribution margin is $100,000. Operating leverage is 5. We determine this by dividing the $100,000 contribution margin by net income of $20,000. Now that we calculated the degree of operating leverage for RBC, let's see exactly what this means to management. If racing is able to increase sales by 10%, net income will increase by 50%. We multiply the percentage increase in sales by the degree of operating leverage. Let's verify the 50% increase in profit. A 10% increase in sales would increase bike sales from the current level of 500 to 550. Look at the contribution margin income statement and notice that income increased from $20,000 to $30,000. That $10,000 increase in net income is a 50% increase. So it is true that a 10% increase in sales results in a 50% in net income. This is powerful information for a manager to have. See if you can calculate the degree of operating leverage for the coffee clutch. The computations took a while to complete, didn't they? You can see that operating leverage is 2.21. If the coffee clutch is able to increase sales by 20%, what will be the increase in net income? You are right. The increase in net operating income is 44.2%. Here is our verification of the increase in net operating income. Take a few minutes and make sure you understand how we calculated all the numbers. High operating leverage ratio signals the existence of high fixed costs, increases risk of making loss in adverse market conditions, increases opportunity to make profit when higher demand exists, has lower margin of safety percentage, MOS percent. Here are the 4 key assumptions of cost volume profit analysis. You are probably familiar with the first 3 by now. The 4th assumption tells us that there can be no change in inventory levels. That is, all units produced are sold in the current period. When a company sells more than one product, break-even analyses become more complex because of the relative mix of the products sold. Different products will have different selling prices, cost structures, and contribution margins. End of Chapter 4.